Good morning, traders. This is Brad Matheny. Today is December 17th. It's still early in the morning. Fairly cold out here in California. And when I say cold, I'm telling you that we are, in the 30s, probably 37 to 40 right now. It's 6 o'clock in the morning. And let's go over the TTScanner Hotlists. As I've been telling you, the TTScanner Hotlists have been slightly adjusting to the market trend. We're starting to see some bullish triggers you can see here and some accumulation, which we hadn't seen before. But we are in a sideways flagging formation, very low volatility, or I should say volume, moderate volatility in the markets as we slide into the end of the year. I don't expect a lot of new triggers in the TTScanner hot list unless we see some sort of a big breakout. But I need you to be aware that these types of triggers that are setting up here with the volatility we have and with the low volume sliding into the end of the year and getting ready for a 2023 potential trend means that we need to be aware that these triggers are at best a little early, potentially volatility driven, and we do not have any real clear trending yet. You can see that here between the bullish, warning, bearish, accumulation, bullish. I mean, it's pretty mixed. So this is the TTScanner Master Hot List. We got out of, last week, we got out of a trade in aerospace and defense, ITA. We've got these longer positions, 23, 44, 48 weeks in length. These have been in place for almost 2 years now. We have no new triggers as of Friday. This was pulled as of Friday. We're watching these new bullish accumulation triggers. These could turn into new triggers eventually, but you can see with the thrusting system, we are negative. Profit factor is mixed a little bit right here, and like I said, we're in a sideways bull flag, in my opinion. And what I think is going to happen is we've reached an apex. We're going to see some volatility. The low volume in the markets right now is going to maybe prompt some really wild price volatility, and we need to stay safely and protectively hedged. Watch the MENT Rotational Modeling System and real estate video. Nothing has changed. We are 20%, 10 to 20% allocated for stock trading, 25% into metals hedge position, 55% into a cash position, and 0% into bonds in our primary allocation level. We are 10 to 20% in stocks for our alternate allocation level, 80% cash, 0% bonds in our alternate allocation level. That means that you should be sitting primarily in cash right now, maybe have a 20-25% metals hedge, and a 10 to 20% trading account, meaning any new trades that come up, you should be trading very, very small allocation levels, maybe 1 to 2% of your total allocation into any one trade, maybe even less, because we are not getting any real strong trending yet. We have been this way for months, and we have been safely protected from our from the rotation in the market. I can't imagine out there trying to swing for the fences, trying to trade when the safest move is to be protected. All right, the value trades. We have one new trigger in Salesforce last week. It's up 2.15%. Right now, the entry price is 131.10. We have not hit any targets yet. We had a bunch of flats this last week. Looks like Cummins went flat, T-Mobile went flat, Walmart went flat. We have a couple of trades here that are holding up, a couple of weeks old. McDonald's is off 3.19%. IBM is off 5.25%. Smuckers is up 8.1%. Amgen is down 0.28%, it looks like. And Merck and Company is up 10.68%. Now, these are 6 weeks old. This is PFG, Financial Group, is off 1.83, has already hit the first target. And Travelers is up 0.48, has not hit the target. So of the most recent trades, what happens with these TTScanner trades is that they will get into a trade and they may risk 2 or 3%, maybe a little more, depending on the volatility in the market. But if the trade does not hold up, if the conditions do not hold up, it will get out of the trade fairly quickly. And remember, as I mentioned to you, we're trading very small amounts of our capital right now. So with like hypothetically a 5% loss here, with if you trade efficiently with a small percent of your capital, would be a 0.05 or a 0.03% loss of your total capital right now, because you would take your 10 or 20% trading capital, you would break that into 10 or 15 or 20 trading slots, and that means that you would be trading, very small amounts of capital. So a 5% loss on 1% or less than 1% of your total trading capital ends up being a very small trade loss. But ideally, when we catch into these trades and when we get some clarity with the MENT Rotational Modeling System, then we'll start allocating more money into these trading allocations, and that'll give us the opportunity to start capturing some of these trends. Right now, if these hold up through the end of the year, we'll see. There's a lot of volatility, a lot of sideways, and I mentioned to you we could see some extended volatility into January 10th, 15th, but I don't expect to see a bunch of new triggers, and I don't expect to see a whole bunch of follow-through until we enter into a brand new trend. Now we'll go to the core system. The core system has a new trade here in PBW. Clean energy is a short. We got in at 43. We're up just about 1% right now. We have a flat trigger here in PBJ. Food dynamics, that was from last week, and all the other triggers are much longer term. And we'll go to the inverse list. We have a flat trigger in ERY that got us out of the trade, and then we've got a couple of trades here in SDOW. It's off 10% right now, and HIBS, Beta Bear, this is a 3X, it's off 17%. Still in the trade, 1 week old. We'll see what happens here as it plays off, but remember, this is, again, you look at these numbers, don't freak out, because we're trading very small amounts of capital. This is a 1.06% loss or less, and this is a 1.73% loss or less, because you have to determine, this is based on essentially what the market has done, but we're only trading 10 or 20% of our total allocation broken into 10 or 15 or 20 trading slots. That means each trading slot is trading between 1% and 0.5% of our total trading capital. So that's why I can tell you that this would be a 1.06% loss or a 1.79% loss or smaller, depending on how you allocated it. So we really don't have any new triggers. You can see here the inverse has gone all bearish pretty much, which means that we are now starting to see upward trending. And the non-inverse core has started to show some bullish trends at accumulation. So we're starting to see some real change in the market here. But we're not getting any real clarity as far as trends. So in reality, ladies and gentlemen, stay safe, stay protected. Do not chase these trends. Do not get crazy trying to swing for the fences here. This is a time where we need to settle into a protected position. We need to slide into the end of the year, not worrying about it. We need to let the markets show us what's coming next, because we don't have any real opportunity to go all in at this point. In fact, that would be probably the most foolish thing that you could do. We've been like this, like I said, for 8-9 months. We have been safely protected, trading small swings here and there, waiting for the opportunities to set up. And that's why I need you to be aware that, the long-term success of trading is to let the markets tell you when it's time to trade, not try to force the markets to move in one direction or another. So watch how this looks at the end of the year. Honest to God, watch how BlackRock and Invesco and all the others do at the end of the year. You're going to be looking at minus 20, minus 30, minus 50% numbers at the end of the year. And like I said, we've been safely protected, sitting mostly in cash, and the MENT Rotational Modeling System has almost turned a bullish trigger a bullish result this year. So it's going to be a real wild year compared to some of the biggest, baddest on the market investment managers, whereas we're sitting over here enjoying, protected, and not really having to worry about things. All right, guys, we'll talk to you later.